Hey, Bubby Trades! I want to do a video analysis update of the stock market. We'll talk about the S&P, Apple, all those stocks, and what I think, right? What I think, and I'll leave the time codes, but I really want to get into what the bears think. To start this video. And it's really an opportunity for me to kind of explain maybe a little bit of my outlook on things outside the stock market, things that relate to the stock market, but maybe aren't the stock market, if that makes sense. So I get called a perma bull a lot, right? And really, I don't care what people think about me, especially my opinions of the stock market, right? But I get called a perma bull, and I think a lot of people get called perma bulls, and maybe they are. But what I want to share is that for the past couple of years, I've really agreed with a lot of the beliefs outside of the stock market that the perma bears have. I haven't agreed with them that we can just draw this little line at this high and this high and this high and just keep drawing this line to Obama levels until it plays out. But I have agreed with them on a lot of things outside the direction of the stock market. What a lot of perma bears believe is that we have a system, an economic system, in America at least, that's crumbling right in front of us. It's breaking apart, and it's basically dysfunctional. So the system is that you are going to work 40, 50 hours a week from the moment you graduate college. For some people, the moment they graduate high school, you're going to work 40 to 50 hours a week. You're going to commute. That's how you're going to get your health insurance. That's how you're going to pay for your meals and your rent. But you're probably never going to be able to buy a house, with that. If for younger people, I talk to a lot of people who, they've been working careers. They've got really nice jobs. They've got all this stuff. They've been working for years. And the idea of buying a house is just laughable. They'll literally laugh. I'm never buying a house, right? College, if you're gonna have kids, like college is just extremely ridiculously expensive, and I know that older generations have dealt with paying for very expensive college for their kids, but college was a lot more affordable. College used to be a lot more affordable, even in the year 2000, 2001. College was completely, drastically more affordable than it is today. The housing is just ridiculous. The college is ridiculous. There's no, most people only work. I know a lot of people who only work just for health insurance. I know people who have worked, 15 years because they needed health insurance, and if they had health insurance, they might have, retired in 2010. But anyway, the point is, I've agreed with a lot of the perma bears on the idea that our, sentiment, our societal structure, our economic structure is crumbling, and it's just the middle class, the proletariat, they're not getting ish. They're not getting ish anymore, and we're just bad negotiators, but it's interesting because it's the opposite view of a lot of, of the baby boomers, who are actually really the definition of perma bulls. They've dollar cost averaged into the S&P for decades, and as they've approached retirement age, which I can statistically show, most baby boomers are approaching or in retirement age. So this says, therefore, in the year 2021, all baby boomers, which is a huge demographic. I think that is the biggest. That is the biggest generation. But all baby boomers will be turning 57 to 75 years old in 2021. That means in 2022, they're all turning between 58 and 76 years old. So for those of you who don't know, 59 is the earliest someone can access their 401k without penalty. Most people would agree, heavily incentivized to not touch the 401k. until 65. And every day, more than 10,000 baby boomers will turn 65 years old, and this rate will continue through 2030. Oh, man. A lot of baby boomers retiring. A lot of baby boomers retiring. And I've been talking to some of them, you know, and maybe for a little context, I come from a little bit of a conservative state, right? So, people are a little more, by the book here, right? And I've been talking to a lot of these baby boomers in this here conservative state, and I've just been asking them. I've said, what are you gonna do if the stock market crashes? What are you gonna do if the stock market crashes in 2022 or any year? And the baby boomers have all responded, "Oh, I'll just keep dollar cost averaging, buying the dip." I'm like, "What? You're retiring? What do you mean? Your whole life savings is in the S&P because you have said for the past couple of decades that that's why the system needs to be supported." The 401k match has been used by the baby boomers for the past couple of years, or really for a long time, as the reason that all the millennials, all the younger generations needed to just blindly keep supporting the system, right? Why would you do anything for yourself? Why would you try to do anything entrepreneurial? Why would you try to learn about money? Why would you try to learn about finance? Why would you even try to do that? You get this free money, 401k, and, who cares that the houses aren't affordable? Who cares that higher education isn't affordable? We get free money in our 401k because for the baby boomers, they've been approaching this retirement age for a while. So the closer and closer someone gets to retirement age, the more their 401k contribution effectively is free money because that match is something they'll be able to access the closer they get to 65. People in their 40s, people in their 30s, it's not necessarily free money to them because money has time value, and if you can't touch something without serious penalty until you turn 65, then anyone who knows about the time value of money knows that's not free. But anyway, the most baby boomers have just been blindly supporting the just ape into the, max out the 401k, max out the contributions, and when you retire, just live off the 4% rule. So most people, whether they know it or not, their retirement plan is that they're going to take 4% out of their 401k every year. So that's called the 4% rule. So that's been the modus operandum for a little bit. In the 80s and the 90s, you could simply invest in the S&P, receive consistently good rates of return. So obviously that was speculation. That wasn't guaranteed to happen. But between 1980 and 1999, there were only 2 years where the S&P had a negative total return. Both pullbacks were less than 5%. You could build a nest egg in your IRA or your 401k plan and know that it would consistently grow by about 10% each year. You could withdraw 4 to 5% of your portfolio in retirement without eroding your portfolio, right? So that's what most people are banking on. They're just going to withdraw 4%. But what happens is if we're in a bear market, when someone retires and they're withdrawing 4%, then they're reverse dollar cost averaging, right? And that's really, really bad. So basically, people have been trying, to find other ways to retire, other ways to figure out how they're going to stop working without relying on the stock market being in a bull. So this guy's answer was dividend investing. He basically said from day one, if there is an investment strategy that could allow you to live off 4 to 6% of your portfolio without having to sell shares in stock or touch your principal, would you be interested? The strategy would be less volatile than the S&P because dividend stocks have lower betas than the S&P, and the income stream generated by this portfolio could grow 5 to 10% each year. So basically, the idea is that instead of taking 4% out of the principal by selling, shares of the S&P in retirement, that someone could just build a dividend portfolio from day one and then live off the 4 to 6% dividend yield instead of withdrawing 4 to 6%. That's kind of one idea. That's kind of just one alternative to this. But I've talked to a lot of baby boomers in 2022, and it's all about supporting the crumbling system, and even just asking them, what are you going to do if we crash? A lot of them are just, they don't have an answer. They don't have a answer at all, right? And so from a technical perspective, I think they're going to be okay, right? In my unprofessional opinion, I think they're going to be okay. I think they're going to get away with it, right? And good for them, right? But from a risk management perspective, I think that's a very, very bad idea to just not have any plan at all, have the entire life savings and the maxed out 401k that you called free money. And so while I get called a permabull a lot, I just wanted to give a little bit of a background that I would get an awful lot of satisfaction, asking all these baby boomers who have encouraged every single younger generation to just blindly support this system, just keep maxing out your 401k, don't even think about anything but working, 45, 50 hours a week, because you get that beautiful 401k match. You're held captive by your employer, right? They could demand basically anything from you, and you don't know anything about money. You have no entrepreneurial skills, and you're entirely banking on the stock market being in a bull. So those 401k contributions let you retire when you turn 60-ish, which is less than 10 years between the age that most people die on average anyway. So I thought that was very, very dumb to hear. And so I just wanted to share that I would be very satisfied if we crashed. If we went to 2,000 for the S&P, I got to buy all of the dividend stocks that just had ridiculous yields. A stock like, Starbucks and Nike, they might be yielding, 7 or 8%. Maybe some of the dividend income stocks would be, yielding, 25%, 30%. The REITs, obviously the bears are going to argue, no, the recession is going to be so bad that we're not going to have REITs. We're not going to have oil and natural gas stocks. We're not going to have banks anymore. All right. Well, we still will have an options market and a stock market. So there will still be, covered call ETFs. There will still be buy right strategies. The implied volatility would obviously be extremely high if this happened. And I think right now, a lot of the buy right ETFs are yielding, over 15%. And as their share value gets lower and the implied volatility gets higher, those could potentially grow. So what I want to do in the first part of the video is just really bring this kind of idea and what my plans are for it to fruition. And I'll talk about why. So for the past 2 years, I've been studying specifically stocks that have low implied volatility with very high open interest and with very high open interest and very high options volume. So I took this picture in March 2021. You can see AMD, Home Depot, Merck, Pfizer, and Royal Caribbean were all on this screen. Some of them had explosive moves to the upside, some to the downside. But what I wanted to share was Pfizer. I saw this, and I was bullish Pfizer in March of 2021. And so what I did is I bought 2 calls for every 1 put. Did a little bit of a ratio trade where it was a bullish trade, but I had 1 put for every 2 calls as a hedge. And to my surprise, with just by the time Pfizer had moved from 33 to 36, I realized that I could have taken a completely neutral trade. I could have not had a bias at all and still had a very profitable trade on my hands. I rode Pfizer options all the way up from 33 to 50, and I made an 1100% return. But what was more cool was that I kept moving up the strike prices of the options to the point where during the entire rally from 34 to 50, if Pfizer had reversed and started crashing, I would have, been okay to the downside. I could have even started making money to the downside. But once Pfizer hit 50, probably, I thought that the decay on the options, even if it kept going up, wasn't worth it. So Pfizer was, a real big, one for me. One of the first ones where, I took information from, the options market and just made a trade directly based on that. And more recently, I've done a very similar thing with ET, as did the institutions. And, what I kind of wanted to share is that a lot of the baby boomers, they think it's just kind of crazy. I've pointed out to some of them, hey, all the baby boomers are retiring like right now. What if the MMs just rug pulled all the baby boomers? They know they're retiring, and they just kind of conspire against the baby boomers and crash the market at the exact moment they're all retiring. And what if they did that, right? And they just thought that was too conspiratorial to think that people could, a group of people could coordinate something like that. And that's why I really like, the trading community, the market community, is because, we do talk about the MMs. We do talk about institutions. You read every day, the MMs are trapping someone. The MMs are trapping these people, that people, right? We talk about the MMs, but we never really acknowledge what the implications of their actions are. So let me just kind of break that down with oil. So on November 11th, all these oil stocks, British Petroleum, ET, Chevron, and Royal Dutch Shell, had very low implied volatility. You can see over here they had IV rank close to zero. So their options were the cheapest they'd been in the past 52 weeks. Wow. They were on a very, very high liquidity screener. They were in the top 200 options volume and open interest for the entire stock market. So this is a screen that also includes ETFs. There's 500 stocks in the S&P, and all these oil stocks together are showing up. So what happened after this? Well, the MMs, let's say they bought a straddle on Chevron when Chevron was at, say, 100. And it was November 15th, and there was a very serious decline after that. Well, when they originally bought a straddle, they had a delta of 50 for the call and a delta of 50 for the put. And then when the oil stocks had a correction in late November, because we were told the economy was going to shut down, so all the retail traders are selling their oil stocks, right, getting out of the big dividend payers right before massive rampant inflation. But anyway, all the retail traders are selling their oil stocks because they're being told that they're being told that the economy is going to shut down. So what are the MMs getting to do? Well, they were very lucky. Right before the announcement about the new variant, they bought a lot of delta neutral straddles. So, lucky them. While all the retail traders are selling in December all their oil stocks, they get to buy shares of these stocks risk-free against those in-the-money puts. So they originally bought a 50 delta call and a 50 delta put, and then as the oil started to correct, the put delta grew higher and higher into the 80s, into the 90s, and the call became weaker and weaker. So what that allowed them to do was not only have a profitable straddle, but also be in a position where they could buy a stock like Chevron, like Royal Dutch Shell, like ET, against those in-the-money puts. And because those puts are deep in the money, they can be exercised. And so if a put has a delta of negative 85, in theory, the institutions could have bought 85 shares of Chevron risk-free, because if Chevron recovers and starts going up, the gamma is going to kick back in, the put's going to become weaker, and it'll become a net long position. And if Chevron keeps collapsing, the delta will go from, say, 85 to 90 to 95 to 100. The put will become stronger and stronger, but it's still just going to be an 85 share long position, so it's going to become a net short position still. So that's why that's called a gamma scalp. when a put becomes deep in the money, or a straddle, the put becomes deep in the money after a straddle is bought, an institution can buy shares of that stock against that in the money put risk free. So that's what the institutions did before oil, right? And then we see that this massive move occur in oil, that particularly screws the proletariat. That really, that basically cut the value of a lot of the purchasing power of a lot of people's money, down significantly, and really coincided with a lot of inflation. It wasn't just oil. We saw, wheat and soybeans, and those are still sectors that I think, I don't think those sectors are done, but we're not even going to get into commodities in this video. And one reason I've been really focusing on straddles recently, these pictures are from mid-September, but it doesn't really matter. It's been, for the past couple of months, we've seen the VIX and VIX and VXX. They've been all over, this same screen too. So institutions have been buying lots and lots of straddles on the volatility index, the VIX and the VIX ETFs, and that's how they've been protecting themselves from whatever's about to happen, right? And maybe, I think there's a very small chance, but maybe the upside move that they're playing is not what I expect. It's not an upside move in the market. Maybe it is an upside move in the VIX. So that's the scenario that I want to play out in the first part of this video. The long-term view, the bears are going to say that we're going to have a wave 2 that corrects the entire cycle for the S&P and takes us to some dot-com bubble highs. In the short term, you're going to see a lot of this on FinSwip, which is you're going to see that from this high, we have an ABC correction. So this is wave A. The bears are going to say that's a wave B little rally we had. So if you take the length of wave A, you place it at the wave B high, that's where the bears are going to get a lot of their wave C targets. So the bears in the medium term think SPY is going to go to around 315 for a wave C. And in the big picture, they're going to say that's just the beginning. We could actually be going all the way down to the 61.8% retracement of this entire rally. And they're going to have us going to Obama levels. So while I don't agree with that from a technical standpoint at all, I agree even less with people who think that you don't have to prepare for this. that straddles and diversifying and owning ETFs that pay dividends, and covered call ETFs that actually will, maybe even help benefit or at least lessen the blow of something like this. A lot of them think that's silly. Why would you even go against the system like that? What that sounds, rebellious even. So I want to get into what my plan is for that. And I also want to make a little bit of a announcement, not really an announcement, but I've been studying these straddles for the past year and a half, and I found a formula that's extremely consistent for generating 25 to 30% returns, really 20 to 30% returns in a matter of months. The risk is very defined, and the hit ratio has been extremely high. Recently, I bought a straddle on Credit Suisse at 252 when it was on the straddle screen, and the call and the put didn't expire for like 10 months, and within less than a month that made a 30% return, and I even ended up selling that too early. I'll get into ET. I've had about 2 or 3 25% returns on straddles, and the metaverse straddle right now, I've got one. It's up 30% in less than a month, and it's gotten really consistent. And really, what I like is methodological. Sorry, that's a tough word. Methodological. Sounds like I'm on methodical right now, but methodical. That's the word I was looking for. It's gotten very methodical, where the stocks show up on a screen, the bar chart straddle screen, the eye volatility screen. I've got a couple of filters that I'm just looking for with my eyes, and then I kind of know Even with the Greeks, what kind of the ratio I want for the Greeks, the gamma to theta ratio is what I call it, has gotten extremely consistent. And to prove that, I'll just show I posted this very recently. These were all bought in the past month. And you guys know I was, at least initially, quote unquote wrong about the direction. I'm not quite, it doesn't matter about being wrong, and that's the whole point. But these are all straddles I bought in the past month. Except for these two that expire in 2024. But all these besides that I bought in the past month. The Metaverse ETF, I bought the 9-strike straddle and the 10-strike straddle. The 9-strike was 200, the 10-strike was 218, and right now the 9-strike straddle is not really up that much; it's up about 7%. The 10-strike straddle, though, is up pretty big. It's went from 218 to, on Friday's close, it was worth 275, so it's up 26%. The put delta is 79. So this is what I want to make sure is clear. If I wanted to, I have a 10-strike straddle on the Metaverse ETF that expires in February. Most of the put is intrinsic value. So if you want to find the intrinsic value for an option, just take the distance from the strike price to, the distance of, what the current price is if the stock's in the money. So if a put's in the money and the strike price is 10 and the current price is 7.60, then 10 minus 7.6 means that about $240 or $240 of that option is intrinsic value, essentially. So at 7.61, this 10 put has about $240 in intrinsic value. If I wanted to offset the delta of this put, so if I wanted to offset the delta of this put, which is getting huge, I'd have to buy 79 shares of the Metaverse ETF. I'd have to invest $600. That would be a pure gamma scalp. What I'm actually doing is the Metaverse ETF has a beta of about 1.85. So since the beta's and it's highly, highly, highly correlated with the market because it's got those big tech holdings as the top holdings. So what I'm doing is, instead of buying the Metaverse ETF, I'm buying JEPI, QYLG, RYLD, and QYLD, the covered call ETFs, and I'm taking advantage of this really high implied volatility, and I'm getting my upside exposure through other avenues. But basically, that's how I'm, what I get to do now is I have deep in the money puts, and as the market falls, I can invest something that's correlated with the Metaverse ETF but has a lower beta, and it's, in a way, not a risk-free position, but a position that's the risk is already managed beforehand. So AG&C Investment Corp, I shared this one that I had a 12-strike straddle. I bought this straight off of seeing the bar chart straddle screen. I found that if stocks with skews, straddles are a little advantageous because with a skew, the put, so basically with a straddle normally, a 12-strike straddle is going to be bought when the stock price is 12. The call is the 12-strike call, and the put's the 12-strike call, or sorry, the put's the 12-strike put, and the stock's at $12. So at the time that a normal straddle is bought, neither of the options are in the money. Neither of the options are in the money because they're both at the money options. With a stock that has a very heavy skew, when a straddle is bought, one of the options, typically for me the call, because the put's going to be more expensive than the call, one of the options is already going to be in the money. So with AG&C, it was about $12.60, $12.70 when I bought the 12-strike straddle, and even though the call was 70 cents in the money and the put was 70 cents out of the money, because of the skew, they were both $94. They were both $94. So anyway, the total was $188. Now this straddle's worth $243. So in less than a couple weeks, that's a 29% return on a directionless trade that's annualized. I've got it paired with the 10-strike straddle that I originally bought for $311, and then when I bought the 12-strike straddle, it was really to lock in the moneyness of the 10-strike straddle. For ET, this one expires in 2024, by the way. For ET, Oh, and also for AG&C, let's just say, for example, that the 12 strike put that expires in March of 2023, March 17th, let's say that delta is 60. If the delta is 60 for the 12 strike put, on this in the money straddle, what that means is that I could buy 60 shares of AG&C, and I would have a risk-free position because there's still a pretty good amount of gamma on this put. So if AG&C keeps falling, the delta would get stronger than 60 shares. It would go 70, 80, 90. And if AG&C started to rally, then the gamma would kick back in, and the delta of the put would get weaker and weaker as the shares for I would still have 60 shares that I bought, but the delta of the put would get weaker, so it would become a net long position. So anyway, that's called a gamma scalp. For energy transfer, 12 strike straddle bought on 4/21/23. Straight off the bar chart straddle screen at 272. Now it's at 300. That's a 10% return. What I wanted to show is that ET. This is the fourth adjustment I've made on ET. Well, I haven't made the adjustment yet, but I've got I've had this strangle on ET that expires in 2024 for a while, and I've been buying straddles kind of paired with it for a little bit. So I'll just show with ET kind of how this one's gone. It's been going on for a while, but if we just look at ET's chart, I originally bought this straddle in March, and I made a 25% return from 10 to 12-ish, and then I adjusted the strike prices from 10 to 12, and then on this decline I made another 25 to 30% return, and then I adjusted the strike prices from 12 back to 10, and then I made about an 8 or 10% return on the way up. I adjusted the strike prices back to 12, and now I'm up 10% again. So 25% up, 25, 30% up, 25, 30% down, 10% up, 10% down, all without picking direction, all while having, an awful lot of exposure. So that's kind of what I wanted to show. I've been working on for a little bit that, maybe I could be in a point where direction doesn't even really matter. And what I'm doing right now is I'm taking advantage of this really high implied volatility, and I'm buying the covered call ETFs against the deep in the money metaverse straddle. So the metaverse straddle is deep in the money. The implied volatility is extremely high, and so I'm buying the covered call ETFs and taking advantage of this IV. And the downside exposure has already been taken care of by the metaverse ETF. So recently I bought Simon Property Group against the AG&C put position. But anyway, let's get into the video. I do think the baby boomers are going to get away with it. I think they will. Now, that's just my opinion. All right, that's not something I'm banking on. It's not something I'm banking on. And, I think there's good reason to there's good reason to look at all these VIX and VIX, the VIX and the VIX readings for VXX and VIX on these option screeners, and be thinking, hey, wait a minute, they might be playing a move to the upside in the VIX. I would say there's a very small probability. It's something that I'm prepared for, but it's definitely not something I'm discounting and saying, oh, no, stocks always recover. But I do think we are going to see stocks recover. SPY, I think this formed a wave 1 and a wave 2 from the 38.2 to 50% fib. For SPY right now, 349, the 50% fib is pretty tight. The 61.8% fib of 318 is pretty wide. I do think this is an ABC correction ending from this high. Wave A places the wave B high is around where wave C's ended, and this is what we call an extreme area. In Elliott wave, 318 is pretty wide. 349 is pretty tight. So the stops aren't very useful for SPY, but I think the price target is pretty important. With this deep correction, this is looking more and more like a wave 2 than a wave 4 or anything like that. This looks pretty clearly like a wave 1, and we're ending wave 2. The bears are going to say the 38.2% fib is a little shallow, for SPY. But what I wanted to share was that the target for SPY, if a wave 3 gets going, is pretty dramatic. It's going to be the length of wave 1 placed at the wave 2 low, and that's going to be the minimum expectation for the wave 3, because wave 3 is usually bigger than the length of wave 1 placed at the wave 2 low. That could take SPY up into the 600s for a wave 3. So I think that all the people who are complaining about stuff being expensive, it's hard for me to talk about stuff being expensive because people have just been so ingrained with the idea that inflation is bad for stocks, and it's just, inflation is just always like a relative term because it's kind of like always happening. So, and inflation kind of affects different areas of the economy and different areas of, markets in general in different ways, right? But I do think when we see SPY get up to the 600s, if we do, that during that time we'll see a nice little bull run in commodities as well as crypto. And I don't think it's going to be the exact same days, the exact same weeks, or the exact same months, or even the exact same quarters that the market, commodities, and crypto, go into a bull. But I think over time that's what's going to play out. So I do think we'll wake up in a world where things are a lot more expensive, and that will include asset prices as well and stock prices. So I think this is wave 1 and wave 2. 349 is extremely tight. 318 is the wider, more meaningful level, but I think we get better levels from other places to the downside in the market. I think Apple is really going to be a smoking gun for bulls. What they're going to look for, and if I remember with bar chart, if I go mark this up and move these fibs, it's going to destroy all of these numbers. So I'm going to have to describe some of the smaller counts in detail. But basically for Apple, from the September 2020 low, right, quad witching date, quad witching date at this high. Anyway, the quad witching dates, these quarterly changes, just are something to pay attention to. And a lot of people, they get so hung up on the actual day of quad witching. Well, we didn't bottom on the actual Friday of quad witching. It's more of like a 2-week grace period before and after the quad witching date. Anyway, I think Apple formed a wave 1 and is ending wave 2 at the 61.8% fib. The length of wave 1 placed at the wave 2 low. If we see that wave 2 low hold, which I think is 129, then the equal legs target for wave 3, that minimum target, is 208 for Apple. And I think Apple's on its way there. I think from this low, Apple formed a wave 1 and a wave 2. So the bulls are really going to be looking for Apple to end this wave 2, not break this wave 2 low, and begin a very powerful wave 3 of wave 3. So that's going to be pretty explosive for Apple if it plays out. And it's certainly going to be very explosive for the market as well. I think Apple's ultimately going into the 200s, and I think it's one of these tech stocks that's giving, from this low. I don't like calling it the low because it's not about calling the bottom, but from the 613 low, at least on the weekly, I think this is a wave 1. We're ending wave 2. We can see Apple get going into wave 3 of wave 3. Here is Microsoft, Mr. Softy. From the 2018 low, I think he formed a wave 1 and a wave 2. I think this is wave 3 and an ABC correction ending wave 4, where the length of wave A placed at the wave B high is where wave C ends at the 50% fib. I like 215 as a stop. I like the invalidation being this wave 1 high of 190 for Elliott wave. There's a principle that says wave 4 retest the wave 1 high, and wave 5 is either the length of wave 1 or the length of wave 3 placed at the wave 4 low. So I won't repeat myself for SOXX, but it's the exact same idea. If I took the length of this wave 1 and I placed it at this wave 4 low, we wouldn't see Microsoft or SOXX make a new high. I think it's going to be the length of wave 3 placed at the wave 4 low is how both of those targets are accurately going to be found. That's going to take Microsoft into the 400s above 215 to 190. Even the mid 400s, and we'll talk about where that would take SOXX to. Nvidia is a little more aggressive of a view from the 2018 low. It's had a deeper correction in an Elliott wave. Deeper corrections, it's not that they're always a good thing, but a corrective wave is either a wave 4 or if it's a wave 2. If it's a deeper correction, it's more likely going to be a wave 2, which means it's followed by generally a very explosive wave 3, whereas wave 4 is only followed by a wave 5 that's strong and fruitful, but it's the last wave in the impulse, at least according to Elliott wave theory. So this is Nvidia. It's a 1, 2, 3, 4, 5 waves up, an ABC correction where the length of wave A placed the wave B high, right around where wave C is. It's not exact. It doesn't have to be exact, but this is an extreme area, right? That's what this is called when we're at the 100% extension of a wave A, wave B, wave C, or what the bears are going to say, wave 1, wave 2, wave 3. Either way, they're going to be looking for a reversal as well. The Elliott wave ones at least. I think this is an ABC correction. The length of wave A placed at the wave B high is where wave C ends. We're between the 61.8 to 78.6% fib of the rally from this low at 31. I think we're going to see a very important wave 2 be put in for Nvidia above 98. There's great risk reward. So just breaking this wave 1 high of 346 would be the RR from there. I think SOXX is giving better levels, really the best levels for the entire semiconductor sector. From the 2018 low, it forms a wave 1 and a wave 2, has this big wave 3, and I think this is an ABC correction where the length of wave A placed the wave B high is where wave C ends. We're at the 50 to 61.8% fib. Wave 4 retests the wave 1 high, so above 269. The length of wave 3 placed at the wave 4 low can give a wave 5 target that takes SOXX up to the 700 level. So we could see an entire ETF full of semiconductor stocks potentially double if that wave 1 high of about 269 isn't broken. Chevron, I wanted to touch on my view of oil for a little bit. Just for in the short term, the bears, if it gets ugly, which I don't expect, the bears are going to look for Chevron. And remember, if I touch these numbers, it's going to mess up everything if I start drawing lines. So I have to draw the lines first and then do the numbers second. Shout out to bar chart. But the bears are going to say, if this gets ugly for Chevron, that this is a wave A and that's a wave B. So to find the next downside area, which I don't believe that's accurate, by the way, but I just wanted to show kind of in line with what I talked about at the beginning of this video. The bears are going to say that's wave A and wave B. The length of wave A placed at the wave B high is going to be how the wave C is found to the downside. I don't think that's going to play out, but I just wanted to share that that's what they expect, and then that would be a very big buying opportunity for Chevron if that occurred, but I don't think it's going to happen. I think that on the all-time chart, this is a wave 1 and a wave 2 for Chevron. Chevron confirmed that when it and ExxonMobil broke the 2014-2015 high. I think this is wave 1 and wave 2. The 161.8% extension of wave 1 is how wave 3 target is found. I think this wave 3 in blue is subdivided into 1, 2, 3, 4, 5 waves. So that 161.8% extension, the low 200s, 200 to 200, 210, I think that's going to be hit for wave 5. I think this is 1, 2, 3, 4, 5 waves. I do think it's a little tight, but I do think we'll hold 132. See Chevron go up into the 200s, 210 area. So I, think oil isn't done, and I kind of like seeing oil move with the market, honestly, because it's then my ET straddle just gives me extra downside exposure, especially since oil can get pretty volatile when it moves with the market to the downside. So here is Disney. I think this is looking really good. I think that I don't even think calling people trolls, you're going to be correct that, I haven't gotten Disney perfectly, but I've always said I like Disney and these travel stocks and the precious metals and in the long term, right? And I think a lot of people, they're very selective with their hearing. They don't like hearing about straddles. They don't like hearing about dividends. They don't like hearing about low beta stocks. They only hear things that are owned by Cathie Wood, but I don't only own stocks owned by Cathie Wood. Anyway, I do own some. This is a wave 1 and a wave 2 for Disney. And for a lot of stocks that are what I call blue chips, I'm taking the long-term approach. I know people hate hearing the word long-term, but that's how the MMs are playing it. All right, we can prove the MMs are playing the long-term game. It's just a fact. They're playing the long-term game. And I posted about Chevron's long-term chart. I don't get them all right, but there's a long list of long-term charts that have played out. All right, I know it doesn't seem like that, but Chevron was one of them. And how did they prepare for Chevron? Well, they loaded the boat with straddles. They got to collect all these dividends risk-free, and they probably even made a lot of money running some covered calls and stuff like that. And they also just made a lot of money on the straddles and the oil stocks that they bought straddles on, like Oxy and Chevron, and XLE and ExxonMobil just exploding. So they're playing the long game. That's the whole point. Disney, I think, is a beautiful long-term chart. 1, 2, 3, 4, 5 waves up. It lines up with the entire travel sector. The kind of elephant in the room is that Disney is also a streaming stock. So this could be very beautiful for two sectors if this played out. The flip side is that the bears would say it's pretty ugly. And we saw Disney get below 79. I love this risk reward right here. We're below that psychological number of 100. We're right next to 79. 1, 2, 3, 4, 5 waves up. Wave 1, wave 2, and this is just too pretty. Another wave 1, another wave 2 at the 78.6% fib. Above 79 is a gorgeous invalidation, gorgeous risk reward. The length of wave 1 places wave 2 low. Gives a minimum wave 3 target of 216 before a shallow wave 4 in a wave 5 higher. Realistically, if Disney puts in this major wave 2 low and gets going, that wave 3 target of 216 is going to end up being too shallow. But I wanted to show even if there was a wave 4 that retests the wave 1 high and a wave 5 higher, Disney can ultimately above 79. That's the risk, and the reward could take it all the way up to the 300s by the time all that plays out. So here is Starbucks. Starbs, I think it's formed 5 waves from this low. 1, 2, 3, 4, 5 waves. Now, I struggle to even say that because then a lot of people, in Elliott wave, the bigger degree, the bigger time horizon is the more important one. Now, a lot of people don't like that because then people will just start zooming out and zooming out and zooming out. But in Elliott wave, the bigger degree is the more important one. So I do think from this low, this is 1, 2, 3, 4, 5 waves. And what a lot of people are going to do is they're going to say, oh, that's 5 waves up, so that's wave 1. Now I'm going to look for the short for wave 2. So you're saying no. When I say that this is 5 waves up, what I'm doing is saying from an Elliott wave perspective, we're getting confirmation that this is a new impulse that's begun. Whether Starbucks pulls back or not in the short term, in the big picture, the fact that this is a 1, 2, 3, 4, 5 waves up for wave 1, we have this wave 2 correction that ends at the 61.8 to 78.6% fib. What Elliott wave theorists will look for is from these anticipated wave 2 lows, do we form 1, 2, 3, 4, 5 waves? Do we start a new impulse sequence higher? I think Starbucks has formed a pretty clear 1, 2, 3, 4, 5 waves up. It supports the idea we've ended the corrective structure for wave 2. We've begun wave 3 to a new high. So I do expect we're going to hold this wave 2 low, 66 to 68. The levels to be above. The length of wave 1 placed at the wave 2 low gives a wave 3 target of 144, which could be followed by a shallow wave 4 and a wave 5 higher. I think 144 is all that needs to be talked about for now. I've gone pretty in depth in Starbucks previously, and not much has changed. So here is Tesla. We had the stock split with Tesla recently, so my numbers all got erased, but the most important count is just from this low anyway. So I think that might actually be a good thing that the larger degree count is gone, because all that matters is from this March 2021 low. I think this is wave 1, and this is an ABC correction wave 2 that's ended at the 78.6% fib, where the length of wave A placed the wave B high is where wave C ends. So there's a lot of XLY holdings that I think are being great evidence for Tesla. There's a lot of clean energy holdings that I think are being great evidence for Tesla. But just for Tesla itself, I think this is wave 1 and wave 2 at the 78.6% fib. A little tight would be 206. 174 is still that wide invalidation, that wave 1 low that Tesla keeps getting further and further away from. And this could be 1, 2, 3, 4, 5. 1, 2. We almost got that 5th one. But anyway, I think this is wave 1 and wave 2. The length of wave 1 placed at the wave 2 low gives a minimum wave 3 target of 442. Tesla starts going, wave 3 is the 161.8% extension of wave 1. For a very volatile stock like Tesla, I would expect a wave 3 to go all the way to the 161.8% extension. But what I'm trying to show is even if that wave 3 was followed by a shallow wave 4 that retests the wave 1 high, if wave 5 is the length of wave 1 placed at the wave 4 low, then we could see Tesla go all the way up into the 600s in the big picture. There's a lot of reward for Tesla above 174. A little tighter would be 206. I think we're starting to see, the more Apple develops, the more Starbucks develops, the more, we've had clean energies just exploded recently. I can't believe I don't even have in-phase pulled up, but that must have been what that other bar chart tab was. But this is in-phase. I think we're getting evidence for a lot of these clean energy stocks. This is the biggest holding of a lot of clean energy ETFs. In-phase formed a wave 1 and a wave 2 from this low, and then it exploded into a wave 3 of wave 3. So what in-phase did is from this low I've had for a little bit, from this May low, this is a wave 1 and a wave 2. So we're going to see in-phase go into a wave 3 of wave 3. The length of wave 1 placed at the wave 2 low gives a minimum wave 3 target, a conservative wave 3 target that we've already seen. But what I'm trying to show with in-phase is that the bigger count that I'm more concerned with, a lot of times the 161.8% extension of wave 1 is reached for wave 3. What I want to show is that even if we have wave 1, wave 2, wave 3, let me just measure it. All right, I'm going to delete these numbers. We're going to go live. We're going live. All right. That's it. We're going live. We're going live. The 161.8% extension of wave 1 is a little off the chart. Damn it, bar chart. All right. Let's get these. But we're going to do a little bit of an approximation. All right. I'm not going to bore you guys with OCD, but let's see. Oh, man. Going live with the new bar chart was a bold move, Cotton. Okay. 282.46 to 82.46. I'm getting the 61.8% retracement of this. And I'm just going to give a little bit of a guesstimation for what this wave 3 161.8% extension would be. It looks like it's about 388. So for the purpose of this video, we'll say the 161.8% extension is 380. Okay, I hope that didn't confuse the crap out of anyone. But the 161.8% extension of this wave 1, we're going to say is 380. So I think that's wave 1, and that's wave 2. Wave 3 can be in process and take in-phase all the way to the 380s. What I'm trying to show is that even if there was a wave 4 after that retested the wave 1 high, if the length of wave 1 placed at the wave 4 low is how a wave 5 target is found, then ultimately waves 1, 2, 3, 4, and 5 can take in-phase up into the mid to lower 400s. So I think that's huge evidence for Tesla. I don't have First Solar pulled up either. What am I doing? I'm kidding. First Solar is a very similar idea, where I think in-phase from an Elliott wave perspective has supported the idea it's going to the 380s in the big picture, the lower to mid 400s in the wider picture after that. First Solar has done a very similar thing. I mean, it's not like bulls don't have any evidence. I mean, but this is, I think for First Solar, I've gone into the account pretty thoroughly, but what it matters most is that from the 2017 low, or the April 2017 low, this is a wave 1 and a wave 2, and this is another wave 1 and another wave 2 that ended at the 61.8% fib. We had this explosive wave 3. We haven't even reached the minimum wave 3 target of 154 yet. The 161.8% extension is 181 before a shallow wave 4 and a wave 5 higher. All in all, I think the 150s to the 180s is next, but ultimately we can see First Solar go all the way up into the 200s for waves 1, 2, 3, 4, and 5. And to me, those 1, 2, 3, 4, 5 waves, that's going to complete a large degree wave 3. So Elliott waves are fractal in nature. The larger degree is from the 2017 low. This is wave 1 and wave 2. So this big wave 3 is in progress. This big wave 3, I believe, is subdivided into 1, 2, 3, 4, 5 waves. The next wave 3 zone is about 155, 154 to 181. But I think ultimately we can see First Solar go into the 200s. Huge evidence for a lot of ESG. NEO would be in that category. I think NEO has formed a wave 1 from this kind of all-time low. And I think this is an ABC correction ending wave 2 at the 78.6% fib. I do expect 11.67 to hold as the wave 2 low. The length of wave 1 placed at the wave 2 low says if NEO is the next Tesla, and that is wave 3, then, man, what am I doing? This is why I have to have all my charts pulled up. But if NEO is the next Tesla, then what this count is going to suggest, I'm just going to be frank, if NEO is the next Tesla and it's acting like Tesla, then this is the wave 2 that I'm looking for right here. I could be completely wrong about that. But if NEO is the next Tesla and it's acting like Tesla, I think it's here. That's my opinion. Could be wrong. But I think this is that wave 2 low. Wave 1, wave 2 at the 78.6% fib. Length of wave A placed the wave B high is where wave C ends. This is wave 1 and wave 2. In phase and First Solar are on their ways to, new highs. I like a lot of, the Chinese stocks. I own a couple of them. I'm bag holding a couple of them, to be fair. But I think this is wave 1 and wave 2. The length of wave 1 placed at the wave 2 low can take NEO up into the 70s for what would be a minimum wave 3 target before a shallow wave 4 and a wave 5 higher. It would replicate this entire rally, and it would be, I think the closest analog would be Tesla after the 2022 wave 2. So, I get that is a bold, expectation. But I think from the Elliott wave standpoint, that's accurate. This is wave 1. That's wave 2. We're going to see NEO enter wave 3 or wave 3. I don't think it'll be easy. But if I was a gambling man, 11.67 holds, and we start a large degree wave 3 for NEO. Plug, very similar idea where we've got some very highly correlated stocks. There's a long list of small cap ESG that would fit into this category. But I think Plug is a good example for this video. Huge wave 1 and wave 2, highly correlated with In-Phase and First Solar. Ran with, the solar sector, ran with, ESG. I think this is a wave 1 and a wave 2 at the 78.6% fib. Plug doesn't really have a very useful downside level of 12. I can confirm the institutions are using straddles and strangles on Plug. We saw a lot of readings on Plug. Not just, we've seen readings on Plug for a while now, but recently we saw a lot in the 22-23 range. Same with NEO. So, I use a lot of different risk management strategies, but straddles, I got straddles straight from the MMs. You can't really study straddles without seeing that this is how they're managing risk. They are not worried about being called a bag holder because they have straddles that they've already bought before the stocks dip. So now they get to buy, while retail stops out, they get to buy their shares risk-free because they're buying against an in-the-money put. So that's how they get all the supply from retail, is that retail is using stops and they're stopping out. They're using straddles that they bought. They pre-hedge their positions, and then as the put leg gets deep in the money, they can buy shares against the in-the-money put based on the delta equivalency. And oh man, we're at the race against time, guys. I got 6% left on my laptop. The Hong Seng, I think this is a wave 1 and a wave 2. We're at the 61.8 to 78.6% fib. Looking for HSI, the Hong Seng, wave 1, wave 2, wave 3 to begin from this 2008 low above 15.5K. We can see the Hong Seng replicate that wave 1 and go all the way up in the long term to the 40K range. We can see a Chinese Indus double. Li Auto, wave 1, wave 2, another wave 1, and another wave 2. I still own XPEV. I'm bag holding XPEV, if that gives anyone satisfaction. But I think Li gave a little bit of evidence by breaking this wave 1 high And I think there's a couple ways to look at Lee. I don't want to get too carried away with the subdivision right now. I think from that low of 15, this could be a wave 1 and a wave 2, and we'd still be expecting an explosive wave 3 of wave 3 for very high beta stocks. Wave 4, breaking the wave 1 high is not uncommon. It's not an invalidation, and this could be 1, 2, 3, 4, 5 waves as well. Taking Lee to new highs. I'm just holding Lee. I don't have a stop. I'm not stopping out of China. If China goes to zero, China went to zero, and I lost everything that I invested, which I managed to risk with position size. And also there was a little bit of correlation for a while with China and ICLN with the clean energy, and also with China and growth, which I'm using the metaverse straddles right now. But I used the ICLN straddles for a while to manage risk in growth sectors that I owned, like China, and now I'm using the metaverse straddle as well to manage that risk. NetEase, I don't think I'm going to need them. I think NetEase says that this is a huge opportunity in Chinese growth, Chinese internet. I know I've been saying that for a bit, but this is the less sexy one, and it's the prettiest chart. Wave 1, wave 2 for NetEase. I think from this low, another wave 1. Gorgeous 1, 2, 3, 4, 5 waves up. ABC correction at the 61.8 to 78.6% fib. 57 is pretty wide, but the length of wave 1 placed at the wave 2 low gives a pretty wave 3 target of the 160s before a shallow wave 4 and a wave 5 higher. The 160s would be a minimum wave 3 target if that played out. Amazon in Ecom, I think from the 2018 low, very similar to some of those other tech stocks we've gone over. 1, 2, 3, 4, 5 waves up. Now kind of like Nvidia at the 61.8% retracement of the rally from the 2018 low. The length of wave 1 placed at the wave 2 low above 91 for Amazon. I like that 78.6% fib. We can see Amazon begin wave 3 that replicates wave 1 up into the 220s. Square or Block or whatever Jack Dorsey decides to call it next, if he's even still the CEO, I have no clue. I think this is a wave 1 and a wave 2. I think this is another wave 1 and another wave 2. And for the first time in a while, I didn't think it would come to this, but we do have a pretty nice invalidation for Square. This wave 1 low of 32, which I'll admit is extremely wide from, when I've originally been talking about Square. Well, just, to be fair, originally talking about Square, kept talking about Square, still talking about Square. So for what that's worth, I know with some people it is about, being right and, whatever. But I think this is a wave 1 and a wave 2. I think this is another wave 1 and another wave 2. I think we're going to see Square and PayPal enter wave 3 of wave 3. Feel very similar about Shopify above 32. I like it a lot. Oh, man, the race against time for crypto. No, I wanted to talk about crypto more. I think Ethereum's looking beautiful. Here is Bitcoin. Bitcoin. 1, 2, 3, 4, 5 waves up. I think this is an ABC correction between the 61.8 to 78.6% fib. I think this is a somewhat arbitrary level, but this, small degree high, I think this is a small degree wave 1 high. So my full count for Bitcoin is that this is a large wave 1, and this is an ABC correction ending a large wave 2. Inside this large wave 1, we have 1, 2, 3, 4, 5 waves, and this is the wave 3. So inside this large wave 3, I don't have it labeled, but I think there's 1, 2, 3, 4, 5 waves subdividing that as well. I know that all sounds like gibberish, but that's why I'm using 13.8K as a wide invalidation. It's really kind of arbitrary. The 78.6% fib, 14.8K is meaningful, but for high beta stocks, that 78.6% fib can get clipped. So I posted about that recently with Penn. I'm managing downside risk in crypto with position size, with hopefully the idea that fiat is still going to be worth something in 50 to 60 years, but that's not why I'm bullish crypto. I'm bullish crypto because of these 1, 2, 3, 4, 5 waves impulses. A lot of them I predicted a massive amount of that rally. Not that it matters, but that was 5 waves up. This is 3 waves back. The next 5 waves up. We're going to be talking about currency risk at that point. Ethereum. We better hope Bitcoin doesn't take 5 waves up, but I think it will. So Ethereum, that 5 waves up for Bitcoin, if it does occur, above 14.8 to 13.8K. The all-time high getting broken would be a very, very, very minimum expectation for wave 3. We could go well beyond that. For Ethereum, 1, 2, 3, 4, 5 waves up. An ABC correction at the 61.8 to 78.6% fib, where the length of wave A plays with the wave BI is exactly where wave C ends, and exactly the 78.6% fib of a beautiful 1, 2, 3, 4, 5 waves up. Does that guarantee anything? Can I tell that to my broker? No, I can't. But oh man, I swore I wouldn't do this. I swore I wouldn't do it. Oh, but I'm gonna do it. I think Ethereum's forming a wave 1 and a wave 2 from this low. I think it's ending an ABC correction. I could be wrong. I could get called a bag holder. Oh no! But I think it's going to happen. I think that's wave 1 and wave 2 from this low. Oh, I promised myself I wasn't going to do this. I promised myself I wasn't going to do the short-term daily count of Ethereum. But I do think that's wave 1. We're ending an ABC correction. We're putting in wave 2. Oh, you guys know why I've gotten a little bold. Oh, no. Ripple's going to do it. Ripple's going to put in wave 3. It's happening. The rippening. Wave 1, wave 2. Another wave 1. Another wave 2. At the 78.6% fib. If Ripple holds above 29 cents, wave 3 of wave 3 can take it to